What's going on, my friends? Happy hump day. Trying to do a video. I'm Sadhguru all of a sudden. Trying to do a video. Trying to do a video every Wednesday. That's what I was trying to get at. Way at the time. Not really busy guy right now. Not a busy guy right now. Want to be a busier guy. Put it that way. Gonna hit on a couple things today. Pretty big stuff going on. Pretty big stuff. Talk about mortgage rates, the markets, do some chart analysis on stock market, bond market, and we're going to take a look at some of the top questions I've been getting and some of what I believe to be the most important things to look at as far as articles, ideas in the marketplace. So first of all, mortgage rates. Yesterday, I couldn't even make a video, and I pride myself on being someone who sticks with it. Even if you don't have good news to deliver, just go ahead and deliver it. And yesterday, I wanted to call 911 and report a murder. If you look at this big red candle right here, worst possible thing. We talked about this. I gave you my analysis on this. And I said, I warned, last time we got up in here, we were ping-ponging around, we sold off. And that's what we were doing. Now, I still like the idea at the time that we'd reclaim the 25-day moving average right there, but rejecting off the 50 and then just pure red. Sell, sell, sell. Absolutely just sucks. And then today, trying to find some support today. Propulsion block did save us today. Here's the propulsion block. This is the order block right here. Propulsion block dips into the order block, close above. So that saved us so far. But there's a lot of liquidation going on in the financial markets right now. A lot of liquidation. I'm going to show you some other charts here in a bit. We're down 20 basis points today. Fortunately, the only good news here really is that mortgage rates pretty much, affected a little bit, but not much for the most part. Now, if you're a low credit score, like high balance conventional borrower, then, rates are really not looking pretty. Not looking so fresh, my friends. But if you're buying a detached home with good credit and a down payment, stuff like that, the conventional rate's still not terrible. Low sevens. 7.375 is no points and no lender fees for us today. So, and the FHA and the VA still mid sixes. And for a lot of these, the rates will be lower. The rates that I post here are just like minimum down payments. With 780 credit, there could be situations where you're going to have lower rates. For example, someone with a really big VA loan, like $1 million plus or something, might get like a 6.25 or less. So just kind of depends. But we're going to look at what is going on in the market specifically, but I did want to show you this. Okay, so high balance conventional rates, super high, getting into the eights. That's with 5% down. Okay, so 5%. I always do these with a minimum down payment, right? So 5% down, 3.5% down for FHA. Jumbo, 20% down minimum, 6.85 on the 5-year ARM. So the ARM's still looking pretty good. Jumbo rates much better than conventional rates. And that doesn't make any sense. Okay, so this is part of the reason and the theory behind understanding why rates are likely to go lower in the future is because the jumbo market is a free market. In other words, no backstop. Whoever's making that loan is servicing it or selling the paper to some other institution that's servicing. No one's guaranteeing it. When you look at conventional loans, FHA, VA loans, these loans are all backed by government in some form or another. And so there's a backing to it. So there's confidence that you can have in the paper. Therefore, they should trade at better deals. You should be able to get a better deal. You shouldn't be able to, as an investor, get bonds that pay out better on those, but you can. So something's amiss. It doesn't make sense. That should normalize. It hasn't. It just refuses to, but it should. When? I don't know, but it should. Let's take a look at a couple things going on this week. So tomorrow, very, very potential, a lot of volatility I'm expecting tomorrow. Jobless claims, 5:30 a.m. here on the West Coast. Productivity and the labor cost stuff I don't think matters too much. But look at this. Look how many Fed presidents are speaking. And these are Eastern times. So 9 a.m., 11:45, 3:30, 3:45, 7 p.m., 7:05. So we're going to have a lot of Fed presidents speaking tomorrow. Could be good or could be bad. I don't know. I'm just saying volatility. I'm expecting the markets to be all over the place tomorrow. And I'll show you why again on the charts here in a second. We're going to look at the San Diego market as well today, just to kind of check in on that here in just a minute. Feel free to drop comments. By the way, we're live on the Book of Faces, LinkedIn, YouTube, and X, formerly known as Twitter. So feel free to say what's up or ask a question if you want. I do have some top questions I'm going to go through once we get through these, and then we'll go to the charts. Mortgage rate tipping point. Homeowners say roughly 5% is the magic number to move. Remember when I said that? This is what I've been saying. 4.99. Give me something that starts with a 4 and watch the market go crazy, folks. Go crazy. That's what's going to happen. Now, we don't know when that will be. It could be 18 months from now. But there is a tipping point, and this is essentially people who are renting and want to get a better deal, or more. This article is more targeting people who are sellers, who are sell buyers, and that's who's sort of left out of this market. It would be very interesting to see what the market looked like if we had more sell buyers participating. We just don't. So I thought it was interesting. That's the number I have in my mind as well. CNBC survey confirms that. Here's something that is posted as sort of a negative. And I really want, if you do anything, share this. If you know someone who's getting married, this is something that should have been done forever. Forever. This should always be the thing. Housing market affordability is so strained that just ignore that. That's the bias. Okay. That's the bias here. Couples want down payment cash rather than wedding gift. That's the actual information. So you see how that piece together? The bias always comes first, right? And then the actual information. It could say couples wise up, become more financially savvy by requesting down payment cash rather than a wedding gift. Genius. Should have been doing this for decades. No reason why this should be a new thing, just because home affordability seems to be strained. But you can see where they're taking you with this, what they're trying to do. Just housing is always under attack, and you know exactly the reason why. I don't need to say it. You already know. Wall Street wants all the houses. Your grandkids will be renters. They'll own nothing, and they'll like it. We have to help prevent that from happening by encouraging homeownership. You got to own a home. So housing market affordability is so strained. But the truth is, couples just want down payment cash rather than a wedding gift, which is a smart move. Encourage this. Send this link. I'll post all the links in the description on YouTube. Send this link to anyone you know who's getting married. Say, hey, put this out there. Put this out there. You get, 1, 2, 3, 400 people involved in your wedding. Send you a gift, $100 here and there. You get a down payment. Boom. Just say, no, seriously, we don't want an air fryer. We don't want a George Foreman grill. We don't want any of that. We have all the household goods we need. What we really need is a house. So I would say take this and let's run with that. All right. This is the big one. So Black Knight, by the way, Black Knight just sold for like $19 billion. Just bananas. But they have this housing price index, right? And this is what they said based on July 2023. So coming through, we don't have August yet, but coming through July, annual growth rate accelerates. Okay, so this is when you can tell something's factual. Home prices, okay, set new record high. New record high. Does that make sense? Should home prices be setting a record high in this environment? A lot of people don't think so, but they are. They are. It's a thin inventory market. Demand isn't going anywhere. Though mixed signals suggest market may be shifting. I really encourage all my friends in the real estate world to read this, and not because there's some impending market crash or anything like that. And I do believe that it's entirely possible that this will be completely unaffected, or San Diego will be completely unaffected by this. But I have seen in some of the other markets that I'm paying attention to a lot more price reductions, and not just little ones, not 10, 15, 50, 70,000 in price reductions. So seeing big numbers. Black Knight HPI hit another all-time high in July. Annual growth rate, 2.3%. And that was only up just about a percent in June. So the re-accelerating annual growth rate was driven as much by price declines of last July, providing a lower starting point as it was by July 2023 gains. Now, what they're saying is, and this is going to get kind of complicated, so I'm just going to let you read this on your own, but basically, the data is showing that it should be stronger given the circumstances. And so they are expecting things to get a little bit weaker in the coming months. Could we see some comp bombs? It's possible. Remember, we've got very low inventory, but our demand is also low. However, the demand is still outpacing the inventory. If that demand were to slip below the inventory pace, or inventory were to jump above where demand is, you could see a comp bomb here and there. And what that is an opportunity for a buyer to get a home under list price, maybe even under market value. I'm not promising that in San Diego. San Diego is very difficult, because there is even less inventory here than there is in other places, and it's low everywhere. Plus, here, the demand is just relentless. So seasonally adjusted price gains were observed in 99 of the 100 largest markets in July. However, growth rates cooled, with 3/4 of markets experiencing smaller monthly gains than they had in June. So they're kind of saying, hey, maybe this is the top. That's what they're saying. They're saying maybe we are now peaking and we're now going to expect a little cooling off heading into the fourth quarter. Keep in mind, in most markets, the fourth quarter isn't so gangbusters. In a lot of markets around the country, it's winter. So the market doesn't do as well as it does in the spring and the summer, or even the fall. Winter is the toughest season for most real estate markets. San Diego is just not like that. So I want you to keep this in mind, because remember, if you're a buyer or if you're a seller and you're in San Diego and you see this and you go, yeah, there's some valid points here. Just remember, they don't say a word about San Diego in here. And a lot of these nationalized articles, they won't understand a local market. That's why it's best to talk to people on the ground in that market, whether it's your favorite realtor or your favorite mortgage guy. But there is validity here. I just don't think that a lot of it has much to do with San Diego. So let's take a look. Let's segue that right into the San Diego market. We always look at the same place. Altos Research, we always look at the same market. That's how we get consistency in our measurements. Now, according to the Market Action Index, things have cooled off a little bit. It was at a 70. It's now at a 68. It's not a lot of cooling off, but it is a little bit. Okay. Median list price still at 1.4. Wild. Inventory has increased slightly. So it's up to 431. A few months back, 357. So slight uptick in inventory. What's been very, very interesting to witness is sort of the drop in rents. As we've seen, that's kind of come down almost 10% in the last, 45 days or so on this index. And you can see the Market Action Index has gone from a 73 down to a 68 in the last few months. So we were kind of seeing a little bit of that too. Price per square foot was $746 back in May. Now $735. So still very close, but a little softening there. Average days on market, though, actually less now than it was 3 months ago. And price decreases have ticked up slightly, but not much. Amount of relisted homes is practically the same. And so it's a little bit of mixed signals, but it's not like booming, raging, crazy, right? It's holding on. It's just hanging on to the cliff there, because it's like, well, there's so many negative things. I mean, we just showed you the article. I mean, that this is not the only outlet that phrases and frames every real estate data point negatively. It's constantly. And you have rates that just relentlessly go higher. And you have, lack of inventory, which just defeats home buyers. I mean, there's so many things that are pounding against the real estate market. But this is the most important lesson. When the market speaks, you must listen to it. Whatever market it is, is the oil market, the stock market, doesn't matter. When the market speaks, you should listen. Remember COVID, especially when it first started. I mean, we thought it was going to be not that COVID was good, but we thought we were going to, watch people pumping gas drop dead. And they framed it was this thing where it was a pandemic. It was the Black Plague. People were going to be dying left and right. And what happened then? Real estate went nuts. The market spoke to us. Hey, shit hits the fan. We're going to real estate. I'm not taking my money in the stock market. Stocks got crushed. Crypto got crushed. Real estate did really well and has ever since. The market spoke to us. People understand real estate. The one thing that you can take away from the previous crash in 2008, the market came back. People thought it would never come back. People thought it would never be the same. People thought that they would just give houses away, I guess. No one really thought that through, did they? Everyone who was claiming that. Obviously, that's not going to be the case. Now, the repercussions of that fallout are actually very bullish for the current market that we're in. Because number one, we're a decade behind or more, 10 or 15 years behind as far as building inventory to meet demand. So it's going to take an eternity, probably a lifetime, to catch up to that. And the banks figured out how to keep what happened in 2008 from ever happening again. It's called forbearance. So between those two things in place, the reality of today's market is we're actually fueled by what happened back then. It's not hurting today, it's helping. And so when you add that all together and you go, all right, we could see a comp bomb here or there. If inventory jumps a little bit up above demand, what you'll see is a desperate seller or two who's got tons of equity go, you know what, just drop it or just sell it, whatever. Drop it 100,000 and see if we can create a bidding war and we'll take 70,000 less or whatever. You might see a comp bomb here and there. A huge opportunity that would be if you do. A huge opportunity that would be. A lot of people right now are not locked and loaded. They're not ready to get after it. And that's going to cost you. The people who are, you may find a deal out there. You might not. You might find just a tremendous competition. But the San Diego market is different. Never forget that. It's different. Cannot believe stuff that is just nationally oriented and that it applies to San Diego. Okay. All right. Let's get to a couple of the top questions here. I'm going to start doing this. These are the questions I'm getting. You can also comment some questions right now if you'd like. Good time to get a HELOC. All right, HELOC interest rates right now are, let's see, let's do this. No, there it is. HELOC interest rates right now, double digits. So even in the best case scenario, you're like high nines. Most people are seeing somewhere between 11 and 15%, depending on when your credit score is, how much, equity you have and stuff like that. But I always try to see, what pencils out the cheapest. I mean, if you want 50 or 75 grand, I've got a buddy who's going to get a pool put in his backyard right now. We're just talking to him about it. Hey, you need 75 grand. You need 50, 75 grand, but you have a $600,000 mortgage at 2% or 3%. It's still going to actually pencil out better off just to get a HELOC versus doing a full refi, cash out. So although it's ugly, it's not what you want. Keep in mind with HELOCs, they're monthly adjustable rates. So as rates go down, the amount of interest you pay each month will also go down. So they are adjustable rates. Now, if rates continue to go up, then the opposite is, of course, true. But it's not a bad time to get a HELOC. There's never really a bad time if you can make sense of the use of the money. Now, don't get a HELOC today and then say, okay, what am I going to do with it? Have a plan. Know what you're going to do with it. If you're going to use it to buy an investment property or you're going to use it to consolidate debts or whatever, have the plan in place before you get the money. Don't blow it, right? Because you are going to pay high interest on it. And eventually you're going to want to refinance it in and consolidate it in with your current mortgage. So it is debt. So don't be careless with it. Have a plan for it. But yeah, there's nothing wrong with getting a HELOC right now. Next, should I buy my rate down? This comes up very regularly. A lot of people are like, well, I see that I could get 6.5% on this FHA loan, but we've got a little extra cash. Should we buy it down into the fives? I just have my straight answer for that right now is I wouldn't if I were you. And there's very good reason for that. We're in a cycle high for interest rates, right? Right now, rates are higher. They've more than doubled, almost tripled in the last 18 months. When we're in a high interest rate environment, you don't want to buy your rate down because it's a 3 to 4 year break even on a buy down on average. So you would have to not refinance for the next 3 to 4 years. And then you would really need to have that loan for another 3 to 4 years to make it worth your while, right? If the break even is, let's say 3.5 years, you want to have it at least 7, 8 years to make it worth the investment because you're investing in a lower interest rate. I'm telling you right now, it's very unlikely that that's going to pencil for you. And you may even lose money doing that. You can lose money doing that. So my suggestion would be this: just basically like self-finance it. Okay. Which means like, hey, if you're going to buy your rate down for $6,000, instead of doing that, what would the payment be? How much is it going to save you per month? And just set that money that you would use to buy it down aside and just allocate that, subsidize that each month into the payment. And what'll probably happen is you'll be able to refi before you've run out of that money, meaning now you haven't wasted it. So that's the safer play to make right now, in my opinion, versus taking the money and giving it to the bank. The banks would absolutely love for you to go ahead and give them that money.
Check, please.
They love it. But I'm telling you, it's probably not going to be a good investment. And it certainly doesn't make sense, in my opinion, from a risk-reward standpoint. That's how I always look at these investments. Risk-reward. Is it worth the risk to pay the money to get the lower rate and lower the payment a little bit? How long is it going to take me to break even? And I always run those calculations for you. So whenever we lock a rate, I always show you the entire rate sheet, the whole thing. So I'd show it to you. Here it is. Nothing is behind closed doors or behind the curtains with us. And I'll show you the calculations and I'll give you the rate sheet so you can do the calculations too. But there's no real good reason to buy the rate down. Now, 2-1 buy down where the seller pays for it, that's a different story. And if you can get that negotiated in, that can really, really help. Because if you think about that, you get a 2-1 buy down, costs about 2%. So if you're buying a $500,000 house, you have to get 10 grand from the seller. So let's say they have it listed for 500. Instead of offering 490, you offer 500, but 10,000 credits from the seller. You use that toward closing costs or buying the rate down. Use it to buy the rate down, using the 2-1 buy down. And now instead of paying 6.5% on an FHA, for example, you pay 4.5% the first year and then 5.5% the second year. And you won't pay the actual 6.5% until the third year if you haven't refinanced yet. And if you refinance anytime in those first 2 years, whatever money is unused from that $10,000 seller subsidy, it comes back as a credit towards your payoff. So you get the money one way or the other. Now that kind of buy down I can get down with. That's the kind of buy down I would use in this market. And I would highly recommend that. If you want to see a lower payment, if you want to see a lower rate, let's talk about a 2-1 buy down. Now, let's say you have a situation where the seller wants that listing price of $500,000. You could always offer them $510 with $10,000 back and try to go that route. Haven't seen a lot of appraisals come in low. Been a long time, really, since I've seen an appraisal come in low. All right, let's see here. Yes, sir. What's up, Michael? We live. All right, let's do. This is the last one I have. Smart to sell and rent. Okay, I got a lot of people right now who are looking at the market and going, I don't feel great about buying in this market, but I feel like it's still a good seller's market. So in other words, I feel like the market is still tilted towards sellers, and I own a home and I've got all this equity, and does it make sense to sell and then rent? And you can do this, and you can make sense of it to some degree. Like if you knew, for example, hey, we're going to be moving to Texas in a year, and who knows what the market will be like a year from now, but we know it's pretty strong right now. Okay, you want to move, this year and then move again next year? That's up to you. That's up to you. I don't think you're going to lose a lot of value in your property over the course of the next year. I think it would be very unlikely in San Diego, for that matter. But you could do that. and I've seen a lot of people talking about this because of just money, almost treating their house like a stock. Well, you know what? Prices are up now. Let me sell it. We'll buy back in a year or two when it's lower. And here's how you do that calculation if you want to consider that. And it's hard to do it with tax advantages and stuff all inclusive, but just look at it just cold cash for cash. So if you're gonna rent a house that's $4,000 a month, that's 50 grand a year. So it's going to be 1-2 years, it's 50 to 100 grand that you're going to be paying towards someone else's mortgage, right? So that's kind of a guaranteed loss. So if you sell your house, what you're saying is you're willing to take a guaranteed loss, a for sure loss, with the hopes that the market will come down enough to make that balance and then some. So if you're going to take a $50,000 loss for sure on just paying rent, not having any tax advantages, not paying into equity, then you're saying that you believe the market will go down more than that. And if it doesn't, then you've actually lost money. So a lot of people don't realize that you can lose money doing that. It sounds like, well, I can't lose because I'll just get back in or whatever, but you absolutely can. So I would be careful about that. Now, I do have a past client right now who he's going to sell his place, I think. And maybe he will. It's an option that we're considering. We got to run numbers. We got to get some more data, but something that I've done in the past, which has been very, very helpful, especially if it's your first house. If you get a bunch of equity in your first house and you want to sell it so that you can buy two. So you sell your first one, you get enough equity that you can go buy another primary and then have the down payment to buy an investment property as well. That I can see making a lot of sense because now you're trading one door for two. So you went from having one door to now having two doors. Now you have a primary and an investment property. You leveraged your equity to do that. That I think can make more sense. Now it's more difficult to buy investment properties now just because rates are higher for those and so forth. But you may be able to buy a new primary this year, let's say, and then buy another primary next year, and one of them becomes an investment. Whatever. There's ways to do it. If you're really trying to create, a real estate portfolio, it could make sense to sell and then turn it into two. If you say, well, I want to wait a year or two to do that, you can do that. Just know what the risks are and run the math. Know how much you need to see the market come down just to break even. Because if you're paying 50 grand a month or 50 grand a year in rent, you need the market to come down 50 grand just to break even, just to be like flat on that move. And so it's a big risk. It's hard. It's very hard to bet against real estate. It's a very, very hard bet to make. It is the investment equivalent of pissing into the wind. It really is. Like occasionally, will the wind stop blowing and shift direction? Sure. It will. Sometimes you'll be right. Michael Burry, who's famous for, The Big Short. They made a movie about him. Christian Bale, blah, blah, blah. He shorted the mortgage market, crushed it. Since then, he's been wrong 11 times in a row. It's hard. He should have just took his money and went somewhere else. Went to his own private island. He made a couple billion, I think, off of that. Should have been enough, bro. Knock it off. You just keep being wrong. He's very short right now, so we'll see. He hasn't got one right in a while. Maybe he's due. I don't know. But for me, the idea of selling to rent needs to be circumstantial. It needs to be, hey, we're going to move in a year. Who knows what the market will be like then, but we know it's strong now. We don't mind moving twice in the next 13 months. Okay, cool. You want to lock your profits in? I do understand that. I do completely understand that. Mind the fact that there's tax advantages if you've been in your property for at least 2 years. If you've been in your property at least 2 years, you can get some exemption from capital gains tax. A married couple gets up to $500,000 tax-free gains on your primary residence. So that's pretty sick. If you can take advantage of that, just don't forget about that. Don't sell your property a year and 10 months into it. Okay. Then you'll get taxed on your gains. And that's a real bummer. Totally unnecessary. Market's not going to shift that much in a couple months. Okay. So that's my 2 cents on that. All right. Now we're going to do some charts. If you like the charts, that's what's coming next. if the charts aren't for you, but you want to help your boy out, I am the least busy I have ever been in the loan business. I've never had this small of a pipeline. Ready to work hard. If you need help with a home loan or know someone who does, have them give me a shout, a text, or an email, and I will hook them up like a tow truck. All right. Get my charts ready over here. Let's go to the S&P. Start there. So, been tracking this, the daily chart on the S&P. We've been looking at this for so long, and pretty much nailed these last two big moves, right? So, this one here is the old sell block up here. We touched that, tried to bust through this upward channel and just couldn't, right? And it sold off hard off of this thing. This was in early August, by the way. That's August 1st right there, August 2nd, just big gap down and just horrific sell-off. We caught this support, though, right here at this bullish order block and bounced off of it pretty high. Got a decent little pop there up to the 618 area and back into this heavy resistance zone. And right now, price is delivering from that. And so the big question right here, we're right in the middle of it. I mean, you can see this. So, I mean, like the big question is, are we headed? Let's see, do I have this? Are we headed to come back down here to support and then shoot higher? That's possible. Are we going to come down here and bust through support and test this trend line right here? Also possible, right? I would not say that this looks good by any means. Like I'm not bullish on this price action whatsoever. To me, it looks like we're going to make a lower low. That's what it looks like, right? We hit support already once, went up, did not get as high as we did last time off of that same support level. Circumstances have obviously changed. And so now we're retreating. So either we make a higher high now. So this is a lower high right here that we just made. This is an equal low. Really, it's a higher low, but just barely, right? So we have a higher low and a lower high. What's next? A higher high or a lower low? One of the two. And that's going to really tell us a lot about what's coming for the markets. And that's on the S&P. So the main index. And that will tell a lot about what's going to happen with everything, really. Probably crypto and the whole shebang. So we're kind of right in the middle of no man's land here. My expectation is lower. Of course, I could be wrong. That is not financial advice by any means. Let's take a look at Bitcoin. I know I got some Bitcoiners who like to get these analyses. So I did get this so far correct in that, these, when we see these channels break, right? This one, Bitcoin tried to break out of this channel, by the way, and it got reclaimed, but then it bounced hard and then back out of it. Okay. So we got out of it to the upside, couldn't sustain that. Now we're out of it to the downside and sitting at this support level. There was a big spike up there on the ETF news, basically the Grayscale lawsuit. The Grayscale got a favorable order against the SEC, and it's likely that a Bitcoin ETF will be approved in the near future. That obviously is turbo bullish for Bitcoin. It looks like the big institutions are finally getting into the game. Remember, in order for an institution to have an ETF, Bitcoin ETF, they have to hold Bitcoin. So if people are putting money into this ETF, they have to then buy Bitcoin in order to cover the amount of money they have in the ETF. This is the one thing that Bitcoin has not had that a lot of stocks and indices do have, which is just constant money rolling in from mutual funds and ETFs. If there is an ETF that for Bitcoin, I believe there will be, there's a short one, there should be a long one. Then what you're going to see is it'll start getting allocated in portfolios. Companies will buy the ETF, 1%, 0.5%, whatever. Mutual funds will have 1 or 2%, exposure because they'll want to have it in their portfolio. And so what that'll mean is whenever those ETFs, whenever those mutual funds, whenever those hedge funds, whenever those corporate balance sheets, whenever they purchase, it's going to bring automatic buyers into Bitcoin. So that's the theory and how it sort of works, why the expectation is high for what's next for Bitcoin, the crypto market. I still believe that we're going to lose this level, though. I do. I think we're going to see a capitulation event. One thing about having the big boys involved is that tons of fuckery. I mean, just tons of it. They're going to mess with it. Volume is low right now. they could easily punch this thing lower and get it at a lower price. And I do believe that they're going to do that. I could be wrong. I hope I'm wrong. But this support so far is holding. I do expect us to lose it, get like a wick down situation, and then move higher from there. So we'll see. 24,000 is where I'm thinking. 23.5 to 24,000, somewhere in there, right in this area right here. That should do it. Okay. Let's take it a couple other fan favorites here. Tesla. Still in the upper channel. Check that out. Remember we were up here at the top, right? Okay. I sold some Tesla right here after we got this, and it just kind of didn't. I was hoping to get a little bounce and sell it, and it didn't happen. So I got rid of some here. Not a lot, but it sells. I feel like I had to book some profits after this enormous run. It's such a good job diamond handing it. And now it's come down. It's tested this channel, but it front ran it. It did. That was a front run. That's a legit front run. I've drawn it a million different ways. That's a front run. So it front ran this trend line here, and now it's come up to the mid zone and it's just kind of bouncing around. So we'll see what happens there. But I do think Tesla, obviously off of this macro downtrend right here, this gray line. Here, I'm not even doing this right. So this right here, this downtrend line, which has been going on for months and months and months. When we got to that point, we claimed it for like 2 days, and then it just couldn't sustain. It was just too much sell pressure with that trend line and this one intersecting, and call it a crisscross. It gapped down and went lower from there. So, it looks like we're going to intersect with this thing again here soon, and it might be finally time for Tesla to overtake this guy. So many bullish things happening on Tesla, but just looking at it from an analysis, not a fundamental analysis, just simply a chartist standpoint, you gotta like the fact that the channel is holding, and I like its chances. The next time we test this trend line here, I like Tesla's chances, and if we get on the other side of that guy and can really sustain there and create market structure there, we may see Tesla price go a lot higher. Never know, anything can happen, right? Financial markets, but looking at that, I like what I see. Meta, kind of the opposite on this one. It was in this upward channel that was so picture perfect for so long. Once it broke, I got out, right? I sold at 295. And I thought I did a great job exiting at that point. Today it's at 299. It got as low as 275. And so sometimes that's the problem with selling. And this is the same thing with housing, right? Like I tell people this story. I sold my house in late 2006. And I was an idiot for about 14 months. And then a genius for about 18 months. And then sheepishly was unable to get back into the market until much later. So when you get out of a market, this is the same thing going back to the question from earlier of, should I sell this one here? Should I sell and rent? Not only do you if you sell, then you have to get back in at the right time. Otherwise you lose. So now you need to do two things right. You need to get out at the right time. You need to get back in at the right time. And if you don't do both right, then you're going to lose. And that's what's hard about it. And so Meta is a good example for that. Now, I still think metaverse, there's a lot of really good things that can happen with Meta. I do. I still think it's got lots of possibilities that are very, very profitable for this company down the road. I was just up too much. I had a triple, and it was getting ugly here. I got out. But I'm still tracking it. I still want back in. I want to start scaling back in. Just need to see some lower prices. It's hard when you bought it at 90, to see it at 290 and want to start scaling in. But at some point, I may just sheepishly have to do so. May not have a choice. Okay, so a couple things here. Long story long. Let me put rates back up. Rates aren't as bad as I believe they should be based on bond market action in the last couple of days. I think that there was some hedge priced in. I think there's a lot of competition happening right now. One of the nice things about being a broker, when I pull up rates, there's dozens of banks competing for the business, and they're sharpening their pencils. They're doing what they need to do to make operations less expensive and try to provide the best possible rates. So there's a lot of competition going on. I think that is helping. I think there was also some hedge, some cushion in there that's now getting just thrown to the wayside because it's time to compete and go and get loans. You know, so these are what rates look like as of the end of the day today. Of course, anything could change tomorrow, but if you want to get, oops, oh no, I think I may have hit the wrong button here. Hopefully nothing crazy happens. If you want to get hooked up on a home loan, give me a shout. Shoot me a call, text, email, whatever works for you. I am not a busy man. I am as free as I could possibly be, but I'm still here working hard, trying to hook people up. Veterans, getting their VA loans, no points, no lender fees, no processing fees, no crap. Wholesale home loan rates. That's what we do. That's how we do it. If you're someone you know needs help, holler. Have a great evening, and I'll be here if you need me.